Today we are analyzing Incyte Corporation, ticker INCY. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. The company has a market cap of $14.6 billion, enterprise value of $11.1 billion, which means they have about $3.5 billion of net cash on the balance sheet, which is actually really interesting. So I'm excited to take a look at that. It's not common that we see a lot of S&P 500 companies with net cash. They're operating in the biotechnology industry. They engage in the discovery, development, and commercialization of therapeutics for hematology and oncology. This is basically blood and other cancers, inflammation and autoimmunity areas of the U.S., Europe, basically internationally. They have different products, coffee. So this is myelofibrosis, lymphoma, so cancer related there. Oncogenic drivers, tumors, cancer, has some other late-stage products. So listing out all these different types of products they have. Basically, it's a biotechnology company focused on pharmaceuticals. They're selling drugs, but biopharmaceuticals, it's kind of a subset of the overall pharmaceutical industry. And they have a beta of 0.71. That's significant because it means it's a relatively lower volatility stock and something to be aware of. That tends to be a positive sign that I like to see. However, this return on invested capital chart is, for lack of a better term, almost disaster. I mean, we have a year here in 2011 where they had negative 126% return on invested capital. So they basically wiped out all their equity. I'm trying to see how this company didn't go bankrupt during that time. They lost money for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 years straight. Now, most likely, as with a lot of biotechnology companies, there's like a startup period. So if we're being generous, maybe they were in the process of starting up during this time frame. You can see here in 2013 when they were losing money, 2014 when they were losing money. They had relatively low revenue, $355 million, $511 million, but it grew pretty rapidly. I mean, you look at this revenue, they went from $355 million in revenue to $3.3 billion in revenue, so the revenue 10x'd over the last decade. And so they were able to do that to get it to turning a profit. And so now some of the recent years return on invested capital, once they turned a profit in 2015, they went up to 11% return on invested capital. They get up to 19% for 2019, 29% 2021. So they're getting strong returns on invested capital now. But historically, they have a lot of issues with losses. So the big question is going to be is what is that going to look like in the future? I mean, one of the things that's common for these type of companies, you have to think is they have monopolies on their products. Those patents protect them from a lot of the competition. So you see some incredible margins like these gross profit margins of 95%. And then, relatively low EBIT margins and stuff like that. That's because they're going to have a huge research and development expense, which is all going to be expensed, and then that's going to impact their actual operating profits. But you're going to see stuff like this where you see revenue of $355 million translating to $354 million of gross profit. Very high conversion rates of gross profit from that revenue growth. So all of this revenue growth is falling into the gross profit line. That's very attractive. But of course, you see still having losses on the operating profit line, even as you're getting this massive growth, because you'd be spending a lot of money on research and development and things like that. Now, what makes this company hard to analyze from either valuation perspective, you see this PE here of 40, or even just quality perspective, is you're bouncing all over the place. You see these EPS lines and you can see, loss of 56 cents, loss of 29 cents, profit of 3 cents, profit of 54 cents, loss of $1.53, profit of 51 cents. Just over that 6-year period, bouncing all over the place. 2018, you made a profit. 2019, you made a profit, but then you lost money in 2020. Are you going to lose money next year? Are you going to make a profit next year? You can't clearly tell if this company is going to be making profits or losing money from any single year, which is almost on its own a disqualifier for me in terms of investing, because I want to invest in predictable companies, and the prime identification of a quality business is one that's profitable and predictably profitable each year in the future. And so we can see here they have a long history of losses. You don't necessarily want to hold that against a company that wasn't making a lot of money, a company that was in a startup phase, clearly a research-based company. They were doing a bunch of research, so they had losses. They probably needed funding for those startups. That's totally fine. you see these amazing revenue growth rates, 27% a year, 33% a year in asset growth. This is the type of revenue growth rate that gives you these 10x's in revenue over the course of a decade. That's incredible. It's very good growth. And if you could repeat it over the next decade and go from $3 billion in revenue to $30 billion in revenue, you're probably going to be very successful as a shareholder, because that money is going to eventually have to drop into operating profit, because you're just not going to be able to spend that much on research and development. So you're starting to get pretty good conversions of that over time. The problem for me is, how do I predict that? How do I predict those returns in the future? Yes, you're growing your revenue consistently, but the bottom line is not being consistent. And so that's all a management issue. That's how the company's being managed. And for me, that just makes it hard to predict. How do I value a company that bounces around like this? Do I use $4 as the earnings, or do I use $1.52? If I use $4 as earnings, then we're saying, hey, the company's trading at a PE of 15. That could be pretty cheap. If I use $1.52, and now all of a sudden we have to say, okay, well, the company's trading a PE of 40, like this 39.9, and the PE is expensive. The other issue with these pharmaceutical companies, biotechnology companies, is they're using those patents to get these really high gross profit margins. When the patent expires, those gross profits are going to decline. And so what they're constantly having to do is research new products that will then be under a new patent and give them new 10, 15 years of being able to sell their product without competition. And so it's a constantly reverting cycle that you have to put a lot of money back into R&D. This can work. There's a lot of good money to be made in the pharmaceutical industry. For me, this company is not really fitting that so far, but let's go see more. Let's look at the financials, see what else we can figure out. If you're enjoying this video, hit that like button. Don't forget to subscribe. Let's go to the income statement. So here's what you see. So your revenue is up 10x, right? 350 million to 3.5 billion. Your SG&A is also up 10x, 110 million to 1.1 billion. Now, if you really want to make this a really strong investment, one of the things you need to do is contain your operating expenses. So you have to keep your operating expenses down as you're growing your revenues, which means, instead of a 10x on your SG&A, how about a 5x? Something like that would allow you to grow much better. Their research development has also gone up significantly, from 260 million to 1.6 billion. So, what's that? 6x, 7x. So now they're not growing the full rate. That's why you went from losing money to making money. But again, they're growing that research and development so rapidly. They're not containing those costs. Now, it makes sense. You're trying to scale. There's all sorts of problems with these companies where you're trying to do that. You're in startup mode, but you can't be in startup mode forever. And the problem for me as a shareholder is I want to own stuff for the long haul. I want to own sustainable companies, high quality companies, and those companies aren't in startup mode. Likewise, we can see they've gone from 148 million shares outstanding to 224 million shares outstanding. So they've added, 75 million shares. They've basically increased their shares outstanding by about 50% over the course of a decade. That's going to be about a 4 to 5% per year EPS drag on the business because they're diluting you so much. They're having to do that because they're not earning enough cash on their own in order to grow organically. Despite having these really good underlying growth rates, they're reinvesting so much in the business that they're continuing to dilute shareholders. For me, this is a problem just because I don't want to be part of a business that's constantly diluting. Now, if they're actually going to stop doing that in the future and it's kind of evened out a little bit, that would be better. And so when we go to the cash flow statement, we're going to take a look at stock-based compensation to really see, is this continuing? Is it getting worse? Well, that's what we're going to analyze in a few minutes. But first, balance sheet. So one of the things I started this video is they had a lot of net cash. So let's see that here. You can see cash building up over time. They have 2.9 billion in cash at 2022. They have 288 million in short-term investments, a decent amount of accounts receivable. PP&E is not a significant amount, 766 million. That's where you're getting pretty strong returns on invested capital, which are even better if you remove that cash from the calculation. They have basically no long-term debt, no short-term debt, so all this cash is net cash. That's a great balance sheet. This is a really good balance sheet to see, is that you're not using a lot of capital in this business. It's very common for pharmaceutical companies. What their real costs are is, instead of capital costs, it's really employee costs, research and development cost. They have basically a sunk cost that doesn't show up on their balance sheet because they invested the income statement, which is here. All of this is investing through the income statement. They're not investing through the balance sheet. A lot of companies in history and historically, you'd think, okay, investments is we're going to retain earnings on the balance sheet in order to reinvest and grow. Research and development based companies are different. They're going to invest through their income statement, so that's going to impact their current earnings. It can make it very difficult to analyze because the reason that you expense R&D is that there's no certainty of any value in R&D. They could put all this money, you could basically pay these employees and get nothing at the end of the year. So you have to expense it due to accounting rules. But you could also put this money into it, $1 billion into R&D, and it could create a product that's going to sell for $10 billion, and there could be a lot of value. And so that value doesn't show up on the balance sheet because it's not a capital investment, it's an employee investment, R&D investment. You have to understand that when you're looking at companies like this, that they are going to show up very differently. However, it does mean the balance sheet looks really, really strong. This is a strong balance sheet for the pharmaceutical company. Now, cash flow statement. One of my big concerns was stock-based compensation, and it looks like they are continuing to dilute shareholders over time. It's not like this has truly fallen off. In fact, they're still issuing a lot of shares, 188 million, 206 million. Perhaps the share count hasn't gone down up as much because of either the stock price has gone up a lot or the stock price has gone down. So the shares, maybe if they're giving options, haven't actually been exercised yet. But regardless, they're continuing to pay a very large amount of shares of stock-based compensation. So we should expect continuing dilution in the future. I don't like seeing dilution like that, and that can be a big concern for me in terms of making an investment. They're not really doing buybacks. They did a little bit of share issuance here in 2017, but no clear buybacks, no dividends. This company clearly doesn't have a lot of excess capital. You see cash flow from operations, and there are a lot of years with very good positive cash flow from operations, and it's showing up just on their balance sheet. They're not investing it. They don't know what to do with it. At some point, they're going to need to make a decision on this and put that money into good use. My first use, is paying stock to employees, start paying them cash. That'd be how I would do it. But the problem for me is this company is not a watch list company for me. I used to really like pharmaceutical companies, but what I don't like now is their unpredictability. I don't like how they're dependent upon patents, because what happens is their gross profit margins can tank as soon as they go off patent. And so then your revenue is going to have a problem. Right now, we're in the massive growth phase of this business. Business looks really good, really exciting. They have cash. Everything looks great, growing really fast. And if it works out, you do really well as a shareholder. Anytime you can grow at revenue growth rates of 27% and they continue, you're going to perform handsomely as a shareholder, because even with some multiple contraction, you can do really, really well. The problem is, will they continue? What happens when the patent expires? How predictable is the business? We can clearly see they're not getting reliable profits year over year. Their expenses are skyrocketing because they continue to reinvest into the income statement with SG&A and R&D. That could mean that pays off very well in the future, or it could mean it doesn't pay off in the future. The problem is I can't evaluate that as an outside shareholder. These companies are probably really interesting to own as an insider, but as an outsider, it's really difficult for me to assess. So for that reason, I'm going to pass on Incyte Corporation. If you learned something from this video, hit that like button. Don't forget to subscribe. Ring the bell so you can get notified when I upload new videos each and every week. And I encourage you to check out quickfs.net. This is the software I'm using to analyze this company. It is available for free or a paid account with the first link in the description below. That is my affiliate link. I can get a commission if you use that link. It's a great way to support the channel, that you can just check them out, use this software. I really love using it. I hope you'll check them out. Thank you for listening, and until next time, stop paying fees, start building wealth.